Welcome to Iron Financial, the only place to forge a stronger portfolio and cut through market weakness. Today, we are putting the Smucker Company, that's ticker SJM, directly under the microscope. Now, this stock just had a massive surge after its latest earnings report. The market is absolutely euphoric. But our job here is to look past the sugar high and to pressure test the fundamentals. So, the core question we're asking today is this. Is Smucker's foundation now built of solid iron, or are we just looking at a sweet but temporary high that's about to come crashing down? Let's get into it. So this is the number that puts Smucker squarely on our radar. A 7.4% jump in a single day. You have to understand, for a 100-year-old consumer staples company, that is not just a move. It's an absolute explosion. This is the kind of price action that just forces you to stop and ask, what in the world is driving the engine here? Was it a complete blowout quarter, a strategic masterstroke we didn't see coming? Or is the market just getting way ahead of itself? This single number, folks, is the catalyst for our entire deep dive today. We need to understand the force behind this incredible momentum. Right, and here's the headline that really sums it all up, the one that everybody's passing around. Results top expectations, and a settlement with an activist investor. Now, my first thought, my gut reaction is always, hang on a second. Is the market just getting high on its own supply here? Are we really seeing a durable, fundamental shift in this company? Or is this just a classic knee-jerk reaction to a couple of flashy data points? It's so easy to get caught up in the big green numbers, but our job is to take a hammer to this story and see if it actually holds up under pressure. This headline gives us the two main pillars of the bull case, the earnings and the activist. Let's find out if they're made of steel or just sand.
Exactly. And to do that, we have to start with the bull case. You simply can't ignore the raw power we're seeing in these results. Before we go looking for cracks, we have to respect the structure that's been built. We need to understand the powerful engine that drove that 7.4% surge. Because on the surface, this really does look like a company that is firing on all cylinders. And this isn't about just one number. It's a whole series of strong operational metrics that paint a very compelling picture of strength and momentum. So let's build that case.
Okay, so the foundation of any consumer titan, any giant in this space, is its brands. And Smucker's portfolio is a fortress. We are talking about absolute heavyweights that own the American pantry. I mean, look at this. In coffee, you've got Folgers and Café Bustelo. These are not just brands, they are daily rituals for millions of people. And they delivered incredible strength this quarter. Then you have the absolute juggernaut, Uncrustables in the frozen aisle, a brand that is a growth engine all by itself. And you can't forget pet foods with Milk-Bone and Meow Mix delivering rock-solid, incredibly reliable performance. So you see, this isn't a company that's just relying on one hit. It's a diversified arsenal of products, and that's the kind of stable foundation that bulls absolutely love to see.
Now, what's really interesting here is how decisively they beat expectations. This is where the rubber meets the road. Wall Street analysts, the people who are paid to model these companies down to the very last penny, they were forecasting adjusted earnings per share of $2.27. Smucker came in at $2.38. That is not a small miss. That is a solid, confident beat. And net sales also outperformed what the street was expecting. In a volatile market like this one, this is the kind of execution that commands respect. It tells investors that management has a firm, steady grip on the wheel and that they're navigating all the challenges of inflation and supply chain issues much better than even the experts predicted. This is the heavy lifting that gets you rewarded.
And this chart, this just brilliantly illustrates the momentum. A 7% year-over-year increase in net sales. Let's be perfectly clear. For a company of this size, of this maturity, 7% top-line growth is muscular. It's powerful. It signifies incredibly robust consumer demand. People aren't just buying their products. They're buying more of them, even with higher prices. And this isn't just financial engineering or some clever cost-cutting. This is real, organic growth, and it's being fueled by those powerhouse brands we just looked at. This is the kind of number that signals true operational strength and market share dominance. But here's the critical point. A single strong quarter is just a snapshot in time. A truly solid company, an ironclad company, has a blueprint for the future. You don't build a lasting structure on one good report. You build it on a clear, repeatable strategy for growth. This is where we separate the flash-in-the-pan performers from the durable, long-term compounders. And Smucker's management team claims to have exactly that. A very specific, very credible plan. It's not just based on hope. They actually call it their growth algorithm. And here is that algorithm, and we've pulled this directly from their annual report. This is their promise to shareholders. It starts with a steady, reliable base, low single-digit net sales growth. Then, through smart execution and cost discipline, they plan to leverage that into mid-single-digit growth in their adjusted operating income. And then the final, crucial step is translating all of that into high single-digit adjusted EPS growth, using tools like paying down debt and buying back their own shares. On paper, this is a clear compounding formula for shareholder value. It's a blueprint for a machine that is designed to consistently grow earnings, year in and year out. This is the core of the bull case, a solid foundation with a clear plan for expansion. All right, a very nice story, a beautiful blueprint for a machine. But a blueprint is just a piece of paper until you actually stress test the materials, right? Now it's time to see if that machine is built with solid steel or if it's got some cheap parts that are going to break down. It's time to take a hammer to these numbers and see if there are any hairline fractures hiding just beneath that glossy finish. Because from where I'm sitting, that beautiful facade is hiding some pretty significant structural issues that the bulls are conveniently, and I mean conveniently, ignoring. Let's dig in.
So let me just ask a simple question. If this quarter was so phenomenally strong, if the engine is truly firing on all cylinders, then can someone please explain to me why the J.M. Smucker Company posted a GAAP net loss for the quarter? Not a smaller profit, a loss. The bulls are out here celebrating an adjusted EPS beat while they're sweeping an actual official by-the-books loss right under the rug. This, to me, is the first major red flag. When adjusted reality and GAAP reality diverge this sharply, you have to start asking what exactly is being adjusted out, and more importantly, why.
And here's the culprit, a non-cash impairment charge. Now, the bulls will try to dismiss this. They'll say, oh, it's just an accounting thing. But let's be crystal clear about what this really means. It means Smucker's is officially admitting that an asset on its books, in this case, the sweet baked snacks unit, is worth significantly less today than what they claimed it was worth before. Think of it like this. It's like a home appraisal coming in way under what you paid for the house. It's a write-down. It's a quiet confession that a part of their business is failing to meet expectations. This isn't just accounting, people. It's a crack in the foundation that raises very serious questions about their overall brand strategy. And hey, don't just take my word for it. Let's look at what the company itself is saying in the fine print of its own annual report. Quote, overall, broad-based supply chain disruptions and the impact of inflation remain uncertain. This isn't a skeptic talking. This is the company's own management team waving a giant yellow caution flag for all to see. They are telling investors in black and white that the operating environment is still treacherous. So while the analyst is over here celebrating one good quarter, the company is warning you about the storm clouds that are still gathering on the horizon. This is a direct contradiction to the whole narrative of smooth sailing. In this slide, this is maybe the most telling piece of the entire bear case. Even after this supposed blowout quarter, what did management do? They trimmed their full-year sales guidance. They actually took the top end of their growth forecast down from 4.5% to 4%. Now, they blamed this on a factory fire, but come on, a resilient, well-oiled machine should be able to absorb a single incident like that. Lowering your guidance for any reason right after a supposed earnings beat is a massive signal. It suggests that the third quarter's strength might not be sustainable and that there are underlying challenges forcing them to be much more cautious about the future. I concede those risks. No company is perfect, and you've made some good points. The impairment charge is a concern, absolutely. And the guidance trim is a yellow flag. But this brings us to the most interesting part of the story, the activist investor. What you see as a weakness, I see as a potential catalyst for massive change. The involvement of a firm like Elliott Management isn't necessarily a sign of a broken company. Often, it's the very thing that forces a good company to become a great one, by sharpening its focus and unlocking value that management was just too slow to address on its own. A catalyst or a crutch? That's the billion-dollar question, isn't it? Is this some sort of healthy collaboration to make the company stronger? Or is this a board of directors that got dragged kicking and screaming to the negotiating table because a powerful activist exposed their weaknesses and threatened a messy, very public proxy fight? Because I see a management team that wasn't acting fast enough on its own and had to be forced into action. That doesn't scream confidence to me. It suggests they needed a powerful external force to make the changes they should have been making all along. Let's stick to the facts of the settlement. Elliott Investment Management, one of the most respected and frankly feared activists on Wall Street, engaged with the company. A cooperation agreement was announced, and the outcome is what really matters here. Two new independent directors, Woo-Sung Chung and David Singer, are being added to the board. This is a tangible outcome. It means new perspectives, new ideas, and more rigorous oversight are coming to that boardroom. You can think of this as a structural upgrade, strengthening governance and aligning the board much more closely with shareholder interests. Look, The company line is that this was a constructive engagement focused on operating improvements. That's the narrative of a partnership. And the skeptics' view, my view, is that this was a defensive move. Elliott showed up, they likely pointed out the underperforming assets like that sweet baked snacks unit we just talked about, and they gave management a choice. Give us board seats and listen to our ideas, or we'll take our case directly to the shareholders and things are going to get ugly. A settlement avoids all of that public embarrassment. It's a company that was forced to the table, not one that was inviting a friend over for coffee. The motivation here is absolutely crucial.
All right, let's just cut through all the talk. Let's forget the press releases for a second and forget the constructive engagement narrative. If you want to know what the people who actually run the company really think about its future prospects, don't listen to what they say. Watch what they do with their own money. The actions of senior leadership, the CEO, the CFO, can tell us more than any polished earnings call ever could. And while the market was getting all excited and the stock was soaring, what were they doing?
Look at this data right here on the screen. The most important line is this one: 0 insider purchases in the last 6 months. Not a single share bought by a top executive. But on the other side of the ledger, it's all sales. As you can see, the CFO, Tucker Marshall, sold over 11,000 shares for $1.2 million, and the CEO, Mark Smucker himself, sold 6,500 shares for over $700,000. That's nearly $2 million in stock sold by the two people who should have the most confidence in the company's future. So I have to ask again, if they truly believe in their own long-term growth algorithm, why are they cashing out? This is a massive vote of no confidence from the people at the very top. Okay, that is a powerful data point. You can't just ignore insider sales of that magnitude. It's a heavy piece of evidence. So it's time to bring it all together. We've examined the bull case, which is built on some very strong operational performance, and the skeptic has hammered away at the cracks in the foundation. Now we have to weigh the evidence from both sides and deliver the iron financial verdict. Let's put everything on the scales and see where we land. Let's do the final weigh-in. The core arguments are clear. On one side, we have undeniable operational momentum.
And on the other, we have some very serious red flags that question the quality and the durability of that momentum. The question for every investor watching is whether this is a genuine turnaround and a real buying opportunity, or if it's just a classic value trap. Let's lay it all out one last time.
So the crucial point on the bull side is this. The foundation is built on tangible, real-world results. A strong Q3 earnings beat on both the top and bottom lines. A muscular 7% year-over-year sales growth, which proves the demand is real. You have incredibly powerful brands like Uncrustables and Meow Mix that are driving that momentum. Crucially, management has a clear, publicly stated long-term growth algorithm. And finally, you have a settlement with an activist investor that injects new blood and new accountability into the boardroom. This is the steel framework of the bull case. But that framework has some serious cracks. The company reported an actual GAAP net loss, driven by an impairment charge that is an admission that a part of their business is struggling. Management themselves, in their own filings, are acknowledging significant uncertainty around the supply chain and inflation. They trimmed their full-year sales guidance, which completely undermines the story of accelerating momentum. They were arguably pressured into a settlement by an activist, which suggests internal weakness. And the final heavy blow, nearly $2 million in stock sales from the CEO and CFO with 0 insider buys. That's a huge crack in the company's armor. Which brings us to our final question. Is the recent success a sign of a company that is forging a new, stronger foundation that is built to last? Or is this just a temporary sugar high, driven by adjusted numbers and a flashy headline that's doomed to fade, leaving investors with a nasty crash? The evidence is on the table. The verdict is yours to render. Is J.M. Smucker's stock built of iron, or is it just sugar? Thanks for watching Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.